The smart money made their move, and in a latest 13F filing we can see what they were buying and selling. In this video I will share with you 5 stocks BlackRock was buying in the latest quarter. BlackRock is the biggest asset manager in the world with assets under management north of 11.6 trillion with a T, trillion dollars. And you know what? Right now you can buy these stocks significantly cheaper than BlackRock bought because of the recent market correction. I will share stocks in order from the smallest position to the biggest position. In addition, I will rank them from top 5 to top 1 depending on what I personally think about the business of these companies and also how attractive is valuation at current levels. Before we start going into top 5 stocks BlackRock were buying, let me mention that before buying any stocks, please make sure you do your own due diligence. And that being said, what's going on, investors? Hopefully guys are doing well out there. Welcome back to another video. Starting from the smallest position, and this is Tesla Maesla. BlackRock acquired Tesla at the prices of $332.74 per share, and right now you can buy significantly lower because currently Tesla is trading at 200. Tesla had a rough beginning of the year with a 37.81% down year to date. Mostly this is related to the decline in sales, especially in Europe, and also close relationships of Elon Musk with President Trump. Tesla's future is packed with promise, starting with the Cybercab, a fully autonomous robotaxi that could hit the roads by 2026. The Tesla Semi, an all-electric truck, promises to revolutionize freight transport with an impressive range up to 500 miles and zero-emission performance. The full self-driving system is advancing fast, aiming to let Tesla cars navigate independently with cutting-edge AI. The Optimus robot is gearing up to handle risky and repetitive tasks, opening doors to a new era of automation. On top of that, Tesla's Megapack energy storage systems are expanding to boost renewable energy use worldwide, paving the way for a cleaner future. In terms of valuation of Tesla Maesla, it's totally depending on what you believe. If you're valuing Tesla as a car company, then Tesla is very overpriced. If you're valuing Tesla as a software, AI and robotics company, probably Tesla is cheap here. But estimating 20% revenue growth with the 10% net income margin and 35 PE in 2029, we have 12% upside for Tesla stock in 5 years. So I would say even after 50% crash from all-time highs, probably Tesla is still not a buy here. And again, it totally depends on what you believe. If you believe Elon Musk's promises about 30 trillion, 50 trillion, 60 trillion dollar market cap, probably Tesla is cheap here. But if you want to play with less risk and try to believe real numbers and real execution, probably you'd better wait for Tesla at 150. For me personally, I have Tesla in my investment portfolio and I would rank Tesla at number 3 because I believe that valuation for Tesla is still a little bit on the rich side. The second company BlackRock was buying is Amazon. Amazon retail business is booming, where improving margins are proving the company's profit power. AI revolution is a tailwind for AWS, as this is the biggest player by market share. Amazon is innovating with shopping AI bot and smarter recommendations for customers. Its fast-growing ads business is taking market share from Google and Meta and growing very rapidly. On top of that, Amazon is rolling out robotics in its warehouses and fulfillment centers, which will cut costs, speed up deliveries, and push retail margins even higher in the coming years. This powerful combo of technology and cost-saving strategies makes Amazon a standout for investors looking for growth and efficiency. Coming to the valuation of Amazon, and this is absolutely my favorite, with very conservative assumptions of 9% revenue growth with operating cash flow margins expanding from 18% to 23%, we get upside potential for amazing zone of 121%, which is absolutely mind-blowing. That's why Amazon is top 1 position in my portfolio, and this is my biggest bet on robotics and AI revolution. To double your money with Amazon, you need to buy Amazon at $217 per share, and currently you can buy Amazon lower than $200 per share. Amazon is a deal in this market, but on the short term it could go lower. I will rank Amazon as a top 1, and this is exactly how I design my own portfolio. Amazon is taking north of 26% of my own personal portfolio. The third company in the list is a Microsoft. Microsoft is powering up its business model with a rock-solid foundation built on recurring revenues that keep cash flowing steadily. The company's shift to cloud computing, led by Azure, is taking market share from competitors like Amazon, and I expect this AI revolution will only accelerate moving into the cloud, which is very bullish for all hyperscalers. Gaming is a growing powerhouse, boosted by the Activision Blizzard acquisition, while the Xbox and Game Pass subscriptions are a reliable revenue stream. The ads business, driven by Bing and search innovations, is also picking up speed, tapping into the digital advertising boom. The mix of recurring income from subscriptions, cloud dominance, and expanding gaming and ad sectors makes Microsoft a finance favorite for investors. Coming to the valuation of Microsoft, Microsoft is very predictable business, designing 15% revenue growth over the next 5 years with net income margin of 36 and price to earnings multiple of 30. I think Microsoft deserves 30 price to earnings multiple, because even during the recessions, people is not going to cancel their subscription to the Microsoft Word, Excel and stuff like this. I think business model of Microsoft is very predictable. That's why this company deserves the premium. Assigning 30 PE for Microsoft with the buybacks of 0.5% and dividends, we get upside potential for Microsoft north of 67% in 5 years. And for me, I would like to wait for Microsoft to buy at least at $350 per share. But Microsoft is a very stable company. I would rank Microsoft as top 2 in my top 5 list. The fourth company in the list is Nvidia. Nvidia has a strong business model with the best positioning for the AI revolution. It's a leader in AI hardware, with chips powering data centers, gaming, and future tech like self-driving cars. The company earns steady cash with software subscriptions and sales to big businesses, hyperscalers. Nvidia is also stepping into physical AI, using tools like Omniverse to help robots and self-driving cars learn better. In the future, Nvidia will grow into robotics, smart cities, and factory automation with its AI skills. Coming to Nvidia here is very difficult to predict because semiconductor industry is very cyclical. But right now, Nvidia is growing extremely rapidly. If we design 20 coming down to 10% growth for the revenue, and also net income margin coming from north of 55% to 50%, with price to earnings multiple of 25, we get 50% upside in the next 5 years. So I would say from the hardware perspective, Nvidia is the leader in the AI revolution. So I think everybody should have exposure to Nvidia in their portfolio. But I would wait to buy Nvidia south of $90 per share. I think this would be a better buy than at current levels. In terms of our ranking, I would put Tesla to the place number 4 and Nvidia will take place number 3. And the final fifth company on the list is Apple, the biggest buy of BlackRock. I definitely did not expect this. Apple has faced criticism for lagging in AI innovation. Despite this, the company is seeing a growing high-margin services business which brings a steady profits. However, its overall revenue growth remains low. The hardware market, especially iPhones, was pressured by competition, especially from the Chinese rivals. And coming to the final company in our list, and this is valuation of Apple. For Apple, the Wall Street is projecting 7% revenue growth. For me, I'm not sure why they are so optimistic, but even if we are projecting in our valuation framework 7% growth over the next 5 years, with net income margin stable at 25% and price to earnings multiple at 25, with the buybacks of 3.5%, we get 30% upside in the next 5 years. I think Apple is extremely overpriced here just because big money believes that this is last general to fall. I'm not sure about that. I do not really believe in the big upgrade cycle. So for me, I would rank Apple as a top 5, even though this is the biggest buy of BlackRock. So here I am not really aligning with the smart money, and over the long term, the time will tell who was right. And here you have it. These were 5 stocks BlackRock were buying in the latest quarter. I hope you enjoyed. If you did, consider subscribing to the channel, and I will see you in the next one.